Today's interview is brought to you by Algorand. You'll be hearing more about them as well as Decipher 2022, their event in Dubai, later on in the show. But for now, let's get on with today's interview. It is the afternoon of Wednesday, November 2nd. Fed Chair Jay Powell just spoke at 2:30 p.m. Before that, we got the statement from the FOMC, the Federal Reserve, at 2 p.m. And I am joined by two experts, Joseph Wang and Jim Bianco. Jim, you're at Bianco Research. Joseph, you used to be a senior trader for the Federal Reserve, and you're the author of Central Banking 101. Guys, great to have you here. I want to hear just your general top level thoughts. What did you make of this? Because the market's kind of spinning, going a little haywire. Jim, how about we start with you?
Yeah, I'm going to use a phrase that I heard John Farrell say on Bloomberg TV, which I think summed it up perfectly. It's no longer about the journey; it's about the destination. And what that means is the Fed going to hike 50 or 75 at the next meeting? It doesn't matter. It's about the terminal rate. Where are they going to end the rate hikes? And he made it very clear he thinks that's much higher. And the market, if you look at the Fed Fund futures, is now pricing in a terminal rate between 5 and 5.25. So they just raised rates 75 basis points today to 375 to 4. There's 150 basis points of rate hikes to go if the market pricing holds. Now, if they want to raise rates 150 basis points in December, or they want to do 625s over the next 6 months, that's where we're going. That's what I think was the cold slap in the face to like the stock market. There's a lot more rate hikes coming, and the composition of how they get there is not as important as where they're going.
Yeah, I agree completely with Jim. And I think I think two things happened at this press conference that I think are important. The first is that there's an extra sentence in the press release, Jack, as you've pulled up. So that extra sentence was initially taken by the market to be dovish. What the sentence seems to suggest is that the Fed maybe might downshift from 75 to maybe 50 basis points hike for December. And the market initially took that as some sort of a pivot, some sort of a dovish move. But Chair Powell really set things straight. And Chair Powell reiterated Jim Bianco's point. That is, it's not about how the pace, but it's really about the destination. That's much more important. And he was unequivocal, as Jim mentioned, that the ultimate destination is much higher. And as an aside, I thought this was Powell's best press conference so far. He seemed so confident, like he was his own man. I mean, he really handled the situation well. I mean, I've watched him since his first press conference, and I think this was his best so far. But he was very unequivocal, and he reiterated his points multiple times. This is not a pause, and we think that rates are going to have to go higher. And by the market's calculation, it seems like we do have, as Jim mentioned, about 150 or so basis points to go.
If I could jump in, and I'm going to ask Joseph about that sentence that they added. The phrase that got everybody excited before the press conference was the term cumulative tightening, and that was meant to mean that they were going to look at the 300 or 400 basis points of tightening that they've done, and that maybe they would pause and let that kind of sink in. And that was before the press conference. That most likely came from Lael Brainerd, because she used that exact phrase, or nearly that exact phrase, a couple of weeks ago in a speech. And the scuttlebutt was, there are a bunch of unhappy doves at the Fed. Maybe Mary Daly, a San Francisco Fed, maybe Charlie Evans, Chicago Fed, Lael Brainerd, the vice chairman, and they were ready to dissent. And Chairman Powell did not want to dissent, because then that would look like the more messiness because of the way the Fed works. So he threw that line in there to kind of get them to at least vote this meeting. The market misinterpreted that line as a pivot, and then I think he's, like you said, Joseph, they set them straight then during the press conference. But I think that's what that line was about, is that under the hood, there's not unanimous agreement at the Fed as to what they should be doing. But Jay Powell's the chairman, and the chairman gets what he wants.
So that what's circled in red there, just on screen, is a line from the statement this November's FOMC meeting that was not from the September FOMC meeting. Pretty much everything else is very, very similar. And it's the quote is, quote, "In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments." So there you're getting sort of the three-part cocktail. Number one is the cumulative tightening, meaning we've already tightened so much, as Jim, you just said. Secondly is the lag with which monetary policy affects economic activity. Oh, if you hike interest rates in May of 2022, it might not affect economic activity until January of 2023, or probably much later. And then economic and financial developments, they're really sort of hedging their bets, saying anything that happens, we can change our minds. Yeah, I actually looked, and it was quite an exhaustive look to see when the last time the Federal Reserve used the phrase lags in the statement, and it was, I believe, 2006, which is interesting. But Joseph, what were you going to say?
No, on this point, so the conventional wisdom is that monetary policy works with long and variable lags. That's standard central bank speak. And I think Powell was asked about this today, and he seemed to a bit more ambivalent about this idea. He rightly noted, that, the way that monetary policy works today is actually the market anticipates what the Fed is going to do. And when it anticipates what the Fed is going to do, it's immediately priced into markets. So when the Fed hikes, it's the tightening is already there. And, maybe the lags are not what it used to be, especially since our economy is a lot more financialized. So I think he's maybe not completely convinced by the standard long and variable lags part of how monetary policy acts.
I'll underscore that and say that that's exactly what I took away from that too, in that this whole idea that, yes, I'll give the doves the cumulative effect with the lag, but he doesn't think there's much of a lag. You're right. We're such a financialized economy. It's already priced in. The effect is, he even said there's been some recent papers that suggest that the lag might not be very much at all. If he's thinking that way, he's not worried that the economy is about to crater because of what they've already done. It's already in the market. That's why he's plowing ahead, thinking we've got much more to go. He's not worried about what's happened.
He specifically noted that he felt that the markets and the economy were handling the rate hikes well. So it seems like that gives him confidence he can continue to go. I want to go back to Jim's point about the agreement on the FOMC, because I think that's a really, really important point going forward. So the FOMC likes to present a unified view, but going forward, it's going to be more and more difficult to have consensus, because you're going to have doves who point at things. And right now, we're still at a time where the economy is strong, where unemployment continues to, be at multi-decade lows. Eventually, maybe in a few months from now, we're going to have unemployment tick up. It's going to be a little bit more difficult call between inflation and full employment. And those doves, they're going to get a lot louder, so it's going to get a lot harder to get unanimity on the FOMC. So I think that's what we should watch for going forward. And I know Jim has a very interesting view. Jim, who do you think is the most hawkish person on the FOMC?
Jay Powell. I think he is the most hawkish person right now. And I think that he is leading the charge with everybody else. I think with him is probably Chris Waller, a Fed governor, and Jim Bullard of the St. Louis Fed. But I do think that, if you were to do that hawk dove thermometer that people do, I'd put him all the way over on the side of being the most hawkish person.
I agree. So that's why we have the messaging we have today. He's trying to do what needs to be done and stay until the job is done, basically.
So the markets really liked that extra sentence in the statement, which was released at 2 p.m. Eastern time. And there was a brief moment of hope in the market where interest rates fell sharply, pricing in not a Fed pivot, but a moderation in forward prices. But Powell dispelled them of that notion, and interest rates actually rose. And now interest rates are even higher than they were before this meeting. And the S&P 500 stocks are the mirror image of that, where they rallied, and now actually the S&P 500 is down 2% on the day of November 2nd. So, Jim, this is the 2-year Treasury yield with sort of a basic chart, but I know you at Bianco Research, you've got these fantastic charts just showing what's going on in the bond market. So tell us about what happened with the terminal rate. That is, the highest point that the market is pricing the Fed will get to? Because I think that it started out, it's kind of a mirror image of that, but it's really interesting just to show the developments today.
Yeah, so the terminal rate, for those of you that want to know how you could calculate it, there's a couple of ways you could do it, but probably the simplest is look at the Fed Fund futures contracts, October, November, December, January, February, March of 23, all the way on out. What is the highest point on that curve? And this is a chart that I do. I did it in Excel just so everybody gets an idea what you're looking at. It's equal max, the function equal max. Where is the highest point in the curve? And it was 510 when I drew it about a half an hour ago. And the bottom line in green shows you what month that occurs in. And what's interesting about the chart is the terminal rate has been in an uptrend, basically since summer. It was still in the mid threes in summer. Now we're already at 4% on the funds rate. And now it's already above 5%. But what else is very interesting is the market, with a couple of exceptions here, is pretty much locked into this idea that the Fed will be done in around April or May with raising rates, that's going to be the time of the terminal rate. That doesn't change, but the rate itself does change. Now, prior to this meeting, this was kind of a wonky thing that, Fed geeks like me and Joseph look at, and a lot of other people weren't really focused on that much. But I think coming out of this meeting, this terminal rate, this is really what we're going to have to focus on. How much they raise in December is, like I said before, it almost doesn't matter. It's where are they going? And probably going to get there by April or May is what the market says. And the last thing I'll say about this is a forward curve. And my standard retort about all forward curves are, they're really important because they tell you what the market thinks and what the market is pricing. This market is pricing a terminal rate of 5 to 5.25. That does not mean, so therefore that's what will happen. Markets get terminal rates wrong all the time, but they're not useless because they tell you what is priced in, what is expected. And what this chart shows, that blue line going up, is that the market continually expects more and more and more of a higher terminal rate. Why do I think it expects a higher and higher terminal rate? Two things. One, the inflation rate is really not moderating that much. We're still above 8%, and it's already November. And yeah, it might come down, and I suspect it will come down, but it's been very slow to come down. And two, the economy is not really showing signs of really getting hit. Now, I agree with Joseph. Maybe in the spring, that'll be a different story. But in November of 2022, the day we're recording, earlier today, we got the ADP report. 239,000 jobs were reported. We've got about that as the expectation for Friday's payroll report. That's not an economy in trouble that is producing 250-ish thousand jobs a month. Economists think that based on population growth and everything else, we need to produce about 50 or 75,000 jobs just to meet that. So if that continues to be the case, that we are seeing okay numbers, initial claims have been in a downtrend since August. If that continues, then there's no reason for the Fed to stop, and that terminal rate will keep going up. And unless an inflation rate really starts coming down, and as we're recording, it hasn't yet, maybe it does, but the Fed's not going to anticipate that. They're going to wait for it to happen before they consider a change in course.
Yeah, as Joseph, as Jim mentioned, the ADP report came out. Workers who had switched jobs, their wages are up, I think, 15.2%. People who stayed in the same job, it's up 7.7%. Not exactly a recipe for deflation or maybe even disinflation. Do you think that report that came out today gave a little bit of pep in his step, Powell, when he's going out and talking to reporters, to really talk hawkish and let the market know that he was serious?
So I think not just that, though. If you recall, the JOLTS data just yesterday also kind of ticked up a little bit. I think Powell's takeaway from this is that looking across many different labor market indicators is that the labor market continues to be very, very strong, and it doesn't really seem to be softening. And if it doesn't soften, that means that wages continue to go higher. That gives people more money to spend on goods and services. And so it makes the Fed's job really difficult. So I think that as long as the labor market is strong, that, as you suggested, Jack, that Powell has the confidence to continue to tighten. Fed, has two mandates: full employment and price stability. As the labor market remains strong, that full employment mandate is met. So all they have to do is focus on inflation, and that's through raising the federal funds rate.
And Jack, you put up the chart of average hourly earnings. I put that in the package here because Jay Powell mentioned this specific statistic. That is the orange line in the bottom, the year-over-year change of average hourly earnings, which has been roughly around in the low 5% range for over a year. The bars in the top are the monthly changes, which have consistently been like 0.3, 0.4, a couple of 0.5 in there as well. And what Jay Powell said is, and I'll summarize what he said. If you're going to see, at least by this measure, average hourly earnings at 5% consistently, he said that's too high for a 2% inflation target. In other words, if everybody's getting a 5% raise, according to the average hourly earnings, you can pay 5% inflation. And we will be stuck with an inflation rate close to 5%. Maybe not quite there, maybe 4.5-ish or 5, but way above 2 is what that is. So when he looks at data like this, and as you mentioned, EDP is a smaller sample set, it's a little bit of a different skew, but it had much, much higher inflation numbers. These are, like you said, if you get a 5% raise, you can pay 5% inflation. We're not going to have 2% inflation in that world. We need wages to go down, wage inflation to go down in order to have inflation go down. And so when he looks at this, he doesn't see any reason to stop right now. And if we don't have a financial crisis and we don't have any signs that the economy is slowing, there's also no reason for him to stop. And I think that was the slap in the face that the stock market got today from this press conference.
On the labor front, one thing I thought was interesting was that he mentioned that, year to date, we basically had 0% real GDP growth, yet at the same time, we're creating jobs every month. So what are all those people doing? I mean, how do we have all these millions of people employed but no GDP growth? It seems to suggest that, productivity is very poor, and that again is not good for inflation.
Not only is it very poor, I was smirking here because I was saying the productivity numbers are the worst numbers they've been since World War II. That if you produce 250,000 jobs a month and you get no GDP growth, it seems like every one of those workers is wasted. I mean, why are we hiring these people if we can't increase the gross domestic product of the country? And so a lot of people have questioned, and Joseph, I'll throw this to you. A lot of people said there's got to be something wrong here. We are not the most unproductive we've been in the last 80 years right now. Or are we the most unproductive we've been in the last 80 years? Do you think this is a measurement problem, or do you think we actually have a real productivity problem right now?
So I'll confess something. So when I was working from home, I was spending half the day watching Netflix. So I wonder if there are more people like me out there.
Maybe that's the $64,000 question. Maybe that is a real problem. Although, if we are all sitting at home watching Netflix and not really working, it's not showing up in corporate earnings because these companies are having no problems making money in this environment either.
Right. Maybe that's part of it. Jim, to what degree is it, though, that real GDP is negative, inflation-adjusted GDP, nominal GDP is high? Maybe it's just the workers who are added, they are adding value. It's just that the value that they're earning, they're adding is not nearly as much as the supply shock, which, Joseph and I, we like to make fun of the supply shock narrative a little bit. But, there definitely is, tons of supply-driven inflation. Perhaps it's greater than 50%, and that is sort of eroding the productivity gains of the workers.
Oh no, it definitely is the case. I mean, as far as the supply shock goes, I also kind of make fun of it as well too, because there's a lot more going on with inflation than the supply shock, and so we're going to have to see some real signs that the demand side of the equation is coming in as well before we start to really talk at all about a pivot. I know I'm kind of pushing one narrative here, but I'm trying to give the people a sense of why the market took this as a cold slap in the face, and that it's something that they weren't expecting. You could see it from the reaction in the stock market today.
I want to ask you both, if the path doesn't matter, it's all about the destination. Forget the journey, to quote Jonathan Farrow. Jim, why not do 75 basis points? If you're going to go to 5% or even 525, 550, why not? Why not do 75 basis points? It seems to me like, if I wanted to make the market think that I was going to hike more than I was, I would do exactly what Jay Powell did today, which is say, don't worry about the journey, just worry about the destination. What do you think, Jim, and then Joseph?
Yeah, just real quick, Jim Bullard, the St. Louis Fed Reserve president, has been saying exactly that. Let's get to that terminal rate as soon as possible, and then let's hold there. Let's not drag this out for a year and a half to get to that level. Maybe they should just raise 150 basis points in December and say, now we're done. Now we're done. We'll just hold here all year and we'll see what happens. But yeah, I think there is an argument to be made. Just get there instead of just torturing everybody all the way through.
Jack, I think they agree with you. That's part of the reason why they're doing 75. I think we really got to remember last year, many people thought the Fed wouldn't hike. And if they hiked, maybe they do 25. Now they're doing 75. And, that's kind of a big leap. So they are trying to get to what they think of as their terminal rate as soon as possible. But I think also that, as Jim suggested earlier, it's harder to get more and more people on the FOMC on board to these supersized hikes. So that's probably also part of it. Some people there want to slow down, want to see if monetary policy is feeding through to the real economy, which is that extra sentence we see in the statement. So that compromise might be just to, maybe get there a little bit slower than Chair Powell might want to. From my own perspective, though, I think if you do act too fast, you do risk the market not being able to adjust and maybe some kind of financial accident. If you were suddenly to hike 200, 300 basis points a day, some people might get caught off sides. There might be margin calls. You could have some disorder in the market, and that's no good for anyone. Might as well, instead of just doing 100, maybe just do 75 and 25, 50, 50. An extra 6 weeks really doesn't make that big of a difference.
Yeah, I want to get into the wonky bond math and the infamous Powell yield curve, which is extremely close to inverting. But first, I just want to go for you a few points, which I feel like people listening who didn't pay as much attention to this as the three of us did, because it's our job, should know about, which is the real sort of hawkish quote was that to pause would be very premature. Powell used those words, and he said it quite forcefully. He also mentioned that the terminal rate is higher than they indicated in the September FOMC meeting, where they actually put out their projections with a dot plot, where there it was about 4.6%. So they're saying we didn't put out a dot plot today, but if we did, it would have been higher, maybe 4.8, maybe 4.9, maybe, who knows, 5.1. And the market went to 5.1. And then just two other questions that, if you guys want to comment on this, just interrupt me and you can talk about it. But reporters tried to get him to ease up, and there's like, but Jay, what about the housing market? I mean, mortgage rates have gone up so much, and aren't you worried you're going to screw up the housing market? And Jay Powell was like, no. And then he was like, but the UN, Jay Powell, the UN is calling you. They're issuing saying the Fed needs to stop raising rates. And I think Jay Powell either ignored the question completely or just said no as well. So Powell was unperturbed. All right, so now let's go on into the wonky bond math. This is really my favorite part, and I smiled when Mike McKee from Bloomberg asked this question. So months ago, maybe you guys can correct me on the date, Powell was asked about, the yield curve inverted. Aren't you worried about that? And the reporter was talking about, what I talk about is the inversion between the 2-year Treasury and the 10-year Treasury, and that 2-year rates were higher than 10-year rates, so that spread was inverted. And then Powell said, oh, no, don't worry about that. What I focus on is the 18th month forward 3-month Treasury bill minus the spot Treasury bill. When that inverts, there's a 100% chance of recession, and there, the Fed should be pivoting. Well, that spread is extremely close to inverting now, a handful of basis points away from zero from inverting. And Jim, you actually, were really lucky to get this on forward guidance, and the audience is lucky to see this. I'm lucky to see this. You made a very up to date spread of this new Fed yield curve today, as of today. So yeah, right. Jim, walk us through the history. Did I miss anything? And what did you think of Jay Powell's answer to Mike McKee's question?
So let me just walk you through the chart. The orange line that you're looking at is this 18-month forward, 3-month spot yield curve. Now, what is that? The way I like to say this is with the interest rate market, you can construct a bunch of forward yields. The simplest way I can explain it to people is we know that there's a 2-year yield and we know that there's a 1-year yield. And we could back into what 1-year yield do we need in 1 year to equal the 2-year yield. So the market we can impute from the market what will be the 1-year rate in 1 year. That's just a simple example. In this case, we are going to take, the 21-month yield and the 18-month yield, and we're going to impute what do we think the 3-month bill yield will look like in 18 months and compare it to the current 3-month bill yield, and that's what this yield curve is. And when it inverts, that's what Jay Powell said is 100% track record. Now, for those of you that are listening, boy, that's a complicated thing, and I don't know how to find that and where to figure it out. So I put the blue line on the chart. That's a simpler yield. That's the 2-year yield minus the 3-month yield. And you can see it tracks pretty closely with this Jay Powell new Fed curve that we have on there. So if you wanted to track something that approximates this, that you could probably figure out yourself, just look at the 2-year yield minus the 3-month yield. It's pretty close. And what it shows is that both of those yields are very, very close to zero. The 3-month 10-year, which is one that's a very popular one with economists, inverted earlier this week. And it's just only for a couple of days has been inverted. Now, what is it supposed to signal to us when it inverts? It's supposed to signal that the market thinks that the Fed is too tight. That rates in the future are supposed to be, that they're too tight. That's why the yield curve inverts, that current rates are higher than what we think future rates are going to be. But we're not quite there yet. And that was kind of part of Jay Powell's question to Mike McKee was, well, this is very close to inverting and it's 100% record for a recession. And aren't you worried? And his answer was, well, it's not there yet. Call me when it is, even though we're only 20 basis points away. It reminds me of the old joke about what does the window washer say when he falls off the scaffolding, he passes the 3rd floor. So far, so good. And that's kind of what Jay was saying. So far, so good. Yeah, but Jay, we know what's coming next here. And this curve is probably going to invert, but that would be a signal that the Fed is being too restrictive. Now, what's interesting about that is as of November 2nd, it's not yet flashing that the Fed has been too tight. Now, maybe it does in the next couple of weeks or next month or so, that it gives us a solid signal that the Fed is too tight, but we're not quite there just yet. And that was kind of part of his answer, at least what I thought, what I thought his answer was, is that, yeah, that's a concern, but we're not there yet. Call me when it's a concern. I don't know, Joseph,
it was 6 basis points that inverted a week ago, so very close to zero. Joseph, what did you make of this whole interaction?
Right.
I recall towards the end of his answer to that question, he kind of seemed like he just kind of shrugged his shoulders a little bit. He's like, I don't really care.
Yeah, so he ended by saying, that's my answer, which is kind of the
right,
way.
Right. I'm racing rates, and don't give me a reason to stop here.
That's always been my sense, that they don't actually care about the shape of the yield curve, and I can understand why. I mean, it's hard to place a lot of confidence in market signals when, for example, one of your major policy tools is going out and buying bonds to make sure that the rates are lower than they otherwise would be. So if one of your policy tools is to manipulate the yield curve, then obviously you are, I think, more thoughtful when you try to derive signals from it.
Right. And the yield curve does have a good track record of inverting before recessions, but there are different ones that invert at different time horizons. So for example, the 2-year, 10-year spread, that inverts it's 12 months to maybe 18 months before a recession, and that inverted earlier this year. The 3-month, 10-year inverts earlier, and this new Powell yield curve that he likes so much, that inverts a few months before a recession, or maybe perhaps already in one. We interrupt this program with breaking news. Algorand is hosting an event in Dubai from November 28th through November 30th, and I am going to be there. Decipher 2022 is a gathering of investors, developers, and founders featuring deep dives on blockchain's most important topics: interoperability, DeFi, sports, gaming, and the metaverse. It's an unparalleled learning opportunity. You need to be there. Think about it. You're going to be coming from Thanksgiving. Your family members are going to be wondering why you won't stop talking about the Federal Reserve. This is exactly what you need to stay in the most beautiful city in the world and meet and learn from leaders in the blockchain industry. By the way, if you are there, I will talk macro with you. So get a ticket today and come hang out with me in Dubai. Tickets are available now at decipherevent.com. And for a limited time, you can use code DecipherFam22 for a discount on your pass. That's decipherevent.com. There is a live stream, so if you can't be there in Dubai, you can watch it remotely. However, there are certain things you'll only get to know if you're there in person, such as, will I remember to bring sunblock? If you ask me about how the reverse repo facility actually works, will I pretend to know the answer, or will I be honest and say I have no clue? Decipher is hosted by Algorand, the world's most secure, scalable, and sustainable blockchain. Founded by Silvio Macaulay, the co-inventor of zero-knowledge proofs, Algorand recently partnered with FIFA to launch FIFA Plus Collect, the league's official NFT marketplace. With the World Cup going on in Qatar at this time, there are sure to be a ton of eyes and attention on that. So clearly there is a lot going on, not just for the Algorand ecosystem, but in the region more generally. So go to decipherevent.com. It's going to be a great event, and I hope to see you there. Now, let's get back to the interview. I don't know if people asked, people did ask, are you worried about a recession? And Powell's answer to that was interesting. But I particularly want to draw attention to, someone said, a reporter asked a great question, which is a soft landing still possible? And Powell said, soft landing, has the probability of it narrowed? Yes. But is it still possible? Yes. What do you guys think of that?
I'm not as deep into the economic data as Jim is, so I'm going to defer to him. But his argument seemed to be that inflation is more more sticky than we thought, and so we're going to have to hike rates higher. And his reasoning is that when you hike rates higher, it becomes less likely for you to get a soft landing, and that makes sense to me. I mean, when you hike, maybe the impact of rate hikes is not linear. So maybe when you get to, let's say, 5 and above, you suddenly slow the economy a lot, and that blunt tool might make a soft landing less likely. But yeah, so far it doesn't seem to be working. I mean, there are reasons to think that the U.S. economy may actually be quite resilient. It certainly looks that way to me so far. But Jim, what do you think?
No, I agree. I think that he is not as concerned about a soft landing as he is about inflation. And yes, it's always possible that until you have a recession, it's always possible that you can have a soft landing. But if anybody's ever played poker, you can always have it. You can always pull an inside straight, but good luck trying to do that at the poker table. It's really a lot harder than it sounds just to say it. And that's almost what the Fed is trying to do right now. And so, yeah, okay, maybe we're going to get a soft landing. But I think what's been happening here, and I'll direct this at you, Joseph. I'm going to throw out the big picture thing. And that chart you had up a second ago of the forward curve, that one right there. And I'll start by explaining this chart. That black line on there is CPI, monthly CPI. And all those colored lines, every month Bloomberg does a survey of economists, about 70 of them. And they ask them, what do you think the inflation rate is going to be over the next 6 quarters? And that's the median for every quarter. What is the pattern you see in this chart? Wherever the inflation rate is, in 6 quarters, it's going to be 2%. As it has gone up for the last 18 months, every month this is the high, we're going right back to 2%. This is the high, we're going right back to 2%. What this chart tells me is transitory still lives. It was 1 year ago at this meeting when Powell tried to, bury the word transitory. Okay, it's Voldemort. We're not allowed to say it, but we all still believe it. And that's what this chart shows me, is that we all still believe that this inflation is ultimately transitory, that it is going to dissipate back to 2% in a year or two to be done with forever. Now, why is that important? Because what I've argued is Jay Powell does not give that long-term speech. What is the big picture view of inflation? Is it persistently high? What would happen if you weren't raising 75 basis points? He was kind of asked a question about what would be your signal, or how would you know that inflation is unanchored? And I don't even think he gave a very good answer to that one. He kind of dodged that question, at least what I thought he did as well. But he doesn't give that long-term speech. That because we've got these, and I'm going to channel myself here, because we've got these incipient inflationary pressures, persistent inflationary pressures, we have to get interest rates up a lot and stay up a lot. That's what I believe, but I'm not the Fed chairman. He is. He should give that speech. Why doesn't he give that speech? Why is everything an 8-minute, 28-minute second speech about we're not going to pivot, or the terminal rate's is higher than we think, or we're not going to pause, and every other governor gives a speech basically saying we're going to raise 75 at the next meeting. And this after they said they were going to get rid of forward guidance. Jack, I know you were worried after they said they were going to get rid of forward guidance about the name of your podcast. Well, we've got more forward guidance now than we've ever had after they got rid of it. The reason I don't think he gives that speech is, again, what we talked about with the dissent. There's no agreement. You could get Lael Brainerd, you could get Mary Daly, go out and say, we're going to raise rates 75 basis points at the next meeting because Jay wants that, and therefore they'll say that. But if Jay wants to say, I think we've got an elevated inflation problem for the next several years that was going to require elevated interest rates, they don't agree with that. And they're not going to give that speech. And they don't want to be asked about it because they're going to disagree with the chairman. So because there's not an agreement, that speech doesn't get made. If you look at this chart again, everybody thinks inflation is transitory. They can't figure out why the chairman is raising 75 at every meeting. So they constantly conclude he's going to pause, he's going to pivot, he's going to step down, he's going to moderate, he's going to stop. He has to stop. What is he doing? He's lost his mind. There isn't an inflation problem to warrant this aggressive action. That, to me, is the disconnect that's out there. That's why we have this heightened volatility. That's why markets get disappointed again, like we saw today, because they're so desperate for this idea that the Fed is going to pivot. And I'll throw one other one at you, Jack. I'm going to give you a real outside the box view here. There's not a lot of bears in the stock market. There's a lot of fully invested bears. There's a lot of people that are worried that this market's going to bottom and it's going to rally 40% until early 24. And I'm not going to be fully into it. And, with double levered S&Ps to make a ton of money. And that's what they're all worried about. They're all worried about missing the low and the big rally. So therefore, they constantly keep talking about everybody's too bearish. It's the most bearish it's ever been. Don't get too negative on the market right now. And so we're all worried about this, and this all feeds into this narrative. The Fed's got to stop. The Fed's got to stop. There's no inflation out there. I don't understand what he's doing. He's making a giant mistake. Read Ross Gerber's tweets. Every 5 minutes, this guy's telling the Fed that they've got to stop. Of course, his fund's down 60% because he's in a bunch of racy technology stocks, so he needs them to stop. I like Ross, but come on, Ross, you've been Johnny One Note on this thing and not been right about it all year. And he could attack me if he wants because I just said that about him. But the point is, I think that's the disconnect. He's not laying out this long-term inflation case. And what this chart is telling us is most people are not in that long-term inflation camp. Now, maybe this chart is right. It could very well be right. Maybe my view on persistent inflation is wrong, sure, but at least make that case. He sort of kind of does a little around the edges when he's asked a question or two about we have to get inflation under control today, but why is it even why is there even a need to get it under control if you think it's going back to 2% in 18 months?
Yeah, Jim, you're really preaching to the choir here. I think for folks watching at home, if they or see this chart, they zoom in on this chart, they can actually see in those colored lines some tweets from the summer of 2021 of people saying that don't you know about rental car? If you take out rental car inflation, actually CPI is at zero. But Joseph, the speech
or housing inflation or gasoline or stand on your head and twivel 3 times and there is no inflation. Yes, we've been through all of this for the last 18 months.
Yeah. So Joseph, the point that Jim is making, the speech that Jim wants Powell to make of, hey, actually, we need substantially high real interest rates for a long time, not this whole 5-year real rates where it's based on what the market is projecting for inflation, which is very often wrong as it has been over the past 2 years, but we need the Fed funds rate higher than core PCE. And yesterday's guest on Forward Guidance, Nick Timmeros, he asked that very same question to Jay Powell today. And Powell's answer, I want to hear your take on Powell's answer to that. And I also think that Jim's chart here of showing exactly that, about where current U.S. Treasury rates are relative to the year-over-year core PCE, which is in black. So we need all those colored lines to be above the black line for there to be real spot rates at the very shortest end of the curve, the overnight rate. So yeah, Joseph, take it where you want.
So I think the Jim's graph about how inflation forecasts have been so wrong is one of my favorite charts. It just shows that this establishment just doesn't know anything about inflation. So if you go to economist school, what they'll tell you is that, if you have a credible Fed, inflation is always going to go down at 2%. Why? Because the Fed is credible. So that's why if you're a PhD economist, all the charts you draw, all the models you have inflation going back down to 2%. And as that chart shows, that hump, until we beat that hump to get there, it just gets larger and larger. I think part of the reason why Chair Powell can't really say things like that is because most people in the Fed are PhD economists. What's different is that Fed isn't, that Chair Powell isn't. He's from industry. He's a lawyer by training. And I remember when he first became Fed chair, he kind of viewed those models as for reference only. He kind of understood, as someone coming from industry, that those models aren't all that useful. I think over the years, he maybe became more persuaded by those models. If you recall, when inflation was transitory, when he was telling people that inflation was transitory, he was relying heavily on those models. And now he's come back to where he started. He's becoming to realize more and more that, these guys, they don't really know anything about inflation. So inflation comes down when it comes down. So I'm going to look at the actual data, and so I'm going to keep hiking. And if you're a PhD economist, you still have that view that, inflation is transitory, basically, as that chart shows. So I really think this is just a difference in worldview. And part of the reason why we're in this huge mess is because the establishment view, the stuff that you learn in economist school, is probably just completely wrong. So when it comes to your question, Jack, about Nick Timmeros asking about whether or not the Fed has to raise Fed funds above PCEs and sets, I think my sense is that, Chair Powell noted that it's something he looks at, but it wasn't a strong answer. He's more like, we look at this. We also look at many other things. I didn't feel like it was like a very clear answer. I think from other conversations, he's also noted that he wants basically everything on the curve to be positive in terms of real rates, and we're not there yet on the short end. But getting there.
He did talk about that in the September meeting. This same concept. He was a little bit more emphatic about that he wanted to see all those colored lines are the 3-month to the 30-year yield. He wants to see all of those above the black line. Now, there's some hope that the black line core PCE will come down a little bit too and kind of meet it in the middle. But if the little gray part of that chart is the Cleveland Fed nowcast, and it's got it out to the end of November, still above 5%. Through the end of November at this point. So if it's going to start coming down, it's probably not going to be till next year. But he was a little bit more emphatic about it at the last press conference than he was at this one. And I'm a little confused by it because he was saying it's so much one way and then kind of waffled a little bit on Timmeros's question this time.
Yeah, for those of you who are listening, so Jim's chart shows that we are kind of quite a ways from everything being above 5% PCE. So probably PCE will come down a little bit in the future, and I guess the Fed will keep hiking.
There we go. Joseph, throughout this year, you've been very worried about bond market liquidity, which has steadily deteriorated throughout this year. The UK gilt market had an implosion that required the Bank of England to intervene in late September, and you were worried that that could come to our shores, to the American shores. However, over the past few weeks, you've been talking about this Treasury buyback program where the Treasury would issue shorter-term bills to buy back longer-term bonds for U.S. Treasuries. That's where all the illiquidity and chaos is. And you actually said, yes, there's this huge problem that I've been tracking, and the problem is appearing, but there's a solution. It's the Treasury buyback program. Everything's going to be okay. And even as of today, as yesterday, you seemed like you had faith in this. But I know that just as the Fed releases its minutes from its FOMC meetings, the Treasury releases the minutes from its funding meetings, and that came out today. And I'm actually going to read from an exact quote where the Treasury considered a Treasury buyback for a variety of use cases, including liquidity support and cash management, yada, 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 but that the Treasury has not made any decision about whether or how to implement a buyback program. So basically, if the buyback program is coming, it's not coming until 2023. What's your reaction to that? How significant is that?
My sense is they're not really taking this problem seriously enough. And maybe if you're a government actor, usually you don't want to act preemptively. Usually it makes more sense for something to break and then you come in and save your day. I don't really know. But another interesting thing is that they also revised up their borrowing for the coming months. So they're going to be issuing more debt as well. So I think this Treasury liquidity problem is not going to get better. You have continually high issuance from primary deficit, from QT. You have the Fed hiking. So I think that's it still remains pretty fragile. My sense, though, is that if there's something that breaks in the bond market, we had some cracks in the UK gilt market, it'll probably crack somewhere else before it cracks in the Treasury market. Maybe we have something, let's say BTPs in the Eurozone or something like that cracks, forces someone to do something, and then the Treasury market benefits from that. So that's what I think could happen. But if eventually, though, someone's bond market, I think, is going to crack simply because the issuance is just so high, and there's not enough. I don't think there's not enough marginal buyers to absorb all that. So Governor Waller actually had a very interesting comment. He thinks that liquidity in the Treasury market will come back when the yields get high enough, which makes sense, really, but you just don't really know where that is. And between then and now, that's it could be a lot higher, and that could cause a lot of losses, can cause a lot of financial distress to market participants.
So a couple of things. Since this is YouTube, I'm going to engage in a little bit of hearsay. I talked to somebody this morning after the Treasury refunding announcement came out that knows some of the players. And I asked, does that mean then that the earliest we're going to get a refunding announcement is the February refunding announcement? And they said pretty much yes. So there's not going to be in the next 90 days any kind of a buyback announcement. By the way, your fun trivia question, the last time the Treasury bought back anything was April 2002, 20 years ago. And that was because we were running a surplus and Greenspan was worried that we were going to run out of treasuries and they were buying them all back at that point.
What's a surplus?
That didn't quite... Yeah, exactly. I was going to say they didn't quite work out that way. We still have treasuries. We didn't run out of them like we thought we were going to 20 years ago. But what I think is happening here is in August, there's this animal called the Treasury Borrowing Advisory Committee. It is a committee largely of dealers and some hedge funds that get together once a quarter at the Treasury and advise them on the efficient distribution of Treasury securities to fund the U.S. government. The debt managers at the Department of Treasury that attend this meeting with them view them with a little bit of skepticism. These are a bunch of dealers and hedge funds. They're here to tell me what policies they need the Treasury to do to make sure that their profits are maximized, not what is in the best interest of funding the U.S. government. That's the skepticism that you get. In August, 3 months ago, they gave a presentation and said, liquidity is bad. You need to start thinking about buybacks. My understanding is the debt managers are viewing that a little bit skeptically. Oh, these are dealers. They overstate that. What they really want is they want us to bid up a bunch of securities on their balance sheets that they can sell to us at profits. That's kind of the cynical take that they have with it. I'm sympathetic to that cynical take, but in this case, I'm more with you, Joseph. I think there is a liquidity problem. And I think that if they think that they could wait another 90 days and then announce the beginning of a program, I use the original Top Gun. There was that famous line in the original Top Gun where they had the final battle and they said, the catapult is broken. We'll have another plane in the air in 10 minutes. And he said, BS, this is going to be over with in 2. If the Treasury thinks you're going to wait 90 days to give you a buyback to help fix a liquidity problem, the liquidity problem is going to be in 30 days. It's not going to wait until the middle of next year before we have a liquidity problem. And so they are really rolling the dice here that there is going to be no problem. Given that this Fed has just said the terminal rate's going higher and markets had bad reactions, and if interest rates keep going up and keep stressing markets, we could be a lot closer to something breaking than those debt managers do. So I get it. You want to view everything that a well-heeled hedge fund manager is going to tell you of what is the best thing the Treasury could do to issue bonds when their private plane is paid for by buying those bonds that the Treasury issues. So I get it. You can view them skeptically. But in this case, I do think there is a legitimate liquidity problem. And by just ignoring it for another 90 days may not be the wisest of policies by the Treasury debt managers. And we'll see what happens as we go forward.
Yeah, the 10-year is above 4 again. And like Jim mentioned, terminal rates being guided higher, issuance is exploding higher. So, there's really no reason why the 10-year is not going to continue to go higher. And that stresses the financial system.
Yeah, and Jim, it's possible that the cynical take about those hedge fund managers is true. The reason that they're making this complaint is because they want the securities that they hold to be liquid and bid up in value. But it also can be true that if there is no intervention, that there could really something could break in the financial system.
Yeah, two things could be true at once. That their cynical take is here's a bunch of securities debt managers at the Treasury, please bid them up so I could make more money because gas is going up to fill up my private plane. It's very expensive right now. But at the same time, the reason that these securities are not going up in value is there's a legitimate liquidity problem. And if it gets worse and worse, something can break. And real quick, my line I like to tell everybody about something could break. The bond market is too big, too complicated, and too opaque for anybody to tell me what is going to break. But when you look at the liquidity, you look at the high volatility, you look at rates going up or the total return losses, it is a market that is under extreme stress. Just like no one told me, nor should they have been expected to tell me the day the mini budget came out in the UK, oh, that's it. We've just killed the liability-driven investing schemes of UK pensions. It's too big, it's too complicated, and so we don't know. But we do know that when rates go up and liquidity is this bad and volatility is this high, and you keep stressing these markets, something somewhere will snap. And I don't know what it's going to be, and I don't even think Jamie Dimon could tell us what it's going to be either. But I can tell you, my antenna's up, that we're going to keep pressuring these markets, and somewhere something will be a problem. So yes, two things can be true at once. These dealers are just telling you what they want in order to make more profits, but they could also be right at the same time that there is a liquidity problem as well.
Jim, you also have a really good chart you post on Twitter a lot about the total losses in the bond market year to date. And I think we need to get that in this podcast as well, because that chart just says it all. It's been a historic rout in the bond market. There's a lot of people losing a lot of money. A lot of money basically went poof this year.
Yes. As a matter of fact, credit to Michael Hartnick at Bank of America. They've recalculated a version of that chart back to 1700. Yes, 1700. The government bond markets. And they say that 2022 is the fourth worst year ever, the worst year since 1920, 102 years ago, and only 1865 and 1720, the South Sea bubble, for those of you that are into financial history, have been worse. So this is completely off the rails. And what that chart also tells us is another thing. What happens with a lot of investing schemes is they're based on the current environment. What was the environment to the pandemic? Low rates, 1% rates, negative rates in Europe, low inflation, a Fed that was your friend. Remember that when Powell talked about automatic pilot and trying to reduce the balance sheet in December of 2018, the market threw a fit for 4 days. And then we had the Powell pivot. He turned around and he pivoted that fast after that. So the market was always under this impression that rates are going to be at 1% forever and nothing is going to change that. we can't make enough yield off of that. So what do? We introduce leverage, we introduce derivatives to try and juice returns. Well, now we've got inflation. Now we've got huge sell-offs. That is putting things under pressure. Who has been juicing returns among the most? Liability-driven investing in the UK, and they blew up the worst to date. And so what that tells me is, whether you're talking about risk parity or the 60-40 portfolio, or liability-driven investing with derivatives is a big thing in Canada too, that all of these things were based on an environment of low stable rates, low stable inflation, the great moderation in the economy that no longer exists. So all of these schemes are going to be problematic as we move forward. And right now, I don't see or hear a lot of people saying, the 60-40 portfolio or risk parity, we have to get rid of this scheme because it's not going to work from here on out. No, it's more like we just got to hold on a little bit longer, and then inflation will go back to 2% and everything will be as it was. And that's a prescription for a market that is destined to have a real financial accident.
I agree completely. And I think it's so exciting too.
I agree. I agree because I'm a guy who's been in the bond market for 30 plus years. And believe me, 5 or 10 years ago, wow, God, the most boring place in the world. There's no yield. There's no action. It's you got to get out of the bond market. It's nothing. Well, now the bond market's having its day in the sun again. It's liar's poker 2.0 all over again, right? And that everybody cares about the bond market. Now, at some point, they won't care about it again because that's the way that financial cycles work. But it is very interesting right now.
Right. So Jim, as you said, and Joseph, as you've been saying all year, the raising interest rates reduces the value of bonds, so it imposes losses, huge losses in this case, on the financial system. The question is, who bears those losses? And let's say I have a lot of bonds, I can sort of hedge my interest rate risk by getting into an interest rate contract with Jim, let's say. But now, so I don't have that loss, but now Jim has that loss. So you can, like a hot potato, you can pass the loss around, but you really can't make the loss disappear. So I guess who's going to be left with the losses is my first question. And the second is the dynamic of forced selling. Like, okay, yes, tens of trillions of dollars of wealth has been, it's gone poof, to use your phrase, Joseph. But really the real terror that you see in the market is when you have forced selling where I have to sell my bond in order to meet my redemption. And then that causes the price to go down even further. And then someone else has to sell their bond. So who's going to bear the losses? And secondly, where else do you see pockets of that sort of reflexive selling? Jim, you mentioned that liability-driven investment, LDI, is in Canada. Joseph, let's start with you and then Jim.
So we all bear those losses. I mean, for example, who owns a lot of bonds of Social Security. So, your standard 60-40 portfolio, your standard target date fund, if you work for a company, you're in your 401k, we all bear those losses. And Jack, in your example, let's say someone borrowed money to buy bonds, so they're a levered investor. Your assets decline. Eventually, you get margin called. That's forced selling. That's kind of what happened in the UK as well. What surprises me is that we've had all this destruction in value, but the market's still okay. We haven't had an accident yet, both in the stock market and in the bond market. It seems like so someone in the UK blew up, but so far it seems like it's been calm, and that surprises me a bit. But that's apparently, according to Powell, that gives him confidence to soldier on. So my guess is we'll eventually get to a point where we see distress in a more visible way.
So I agree with you that the markets have held up so far, but they also did till September of 2008 until we got the Lehman advantage. They also did in crypto until the Terra blockchain failed. When you start getting these failures in markets, that is usually the end of the cycle. When you get to the forced selling stage, it doesn't happen in the beginning or the middle of the cycle. It happens at the end. And really what happens at the end is there's a lot of people sitting on unrealized losses, hoping things will turn around and hoping it will get better. And when they start to realize it isn't going to get better, and it's a matter of survival to just get what you can and take the losses and move on, that you get the forced selling, that you get that final capitulation in the market. Since we're on a crypto channel, I'll remind everybody, That's what happened earlier this year. The Terra blockchain failed in May. $50 billion of Luna and UST went to zero in a matter of days. And up until that moment, what did we hear about the crypto space? It was resilient. It was anti-fragile. No one failed. Prices fell. We marked them down. People were liquidated in maker vaults, and everything seemed to work as it did. Then we had the Terra blockchain break, and we opened the gates of hell. We had Three Arrows Capital, we had Voyager Digital, and we had a whole bunch of other failures along the way. And we had ETH and Bitcoin price. ETH price went to under $900. Bitcoin went down to $17,000, $16,000 on a massive capitulation move, and it's been meandering sideways ever since. So I agree with you, Joseph, that it is comforting that this hasn't happened yet. But usually when you get that failure, it's going to be ugly for the next little bit, and then the move's over. And that next little bit, it's not, don't buy on the minute you get that failure, because you can still get half the price movement in a very short period of time. But yet, what I'm trying to say is, when you get that failure, that is a capitulation move. I am sitting on losses now, and the losses get worse as rates go up, but I still believe everything's going to rebound in 23 and I'll be okay. It's when I give up. No, it's not going to rebound in 23 and I'm cooked. And I better get out with something before I'm completely bankrupt. That's when you get that capitulation move. And that happens at the end of the cycle. It doesn't happen near the beginning or the middle. So maybe we're not quite at the end of the cycle, or maybe that's still to come. We'll see. Or maybe this is going to be one of these cycles where we'll be able to avoid that bullet. But that's why I'm not completely shocked we haven't seen it yet. It just signals to me that we're not at the end of the cycle.
Brilliant. Well, guys, we'll have to leave it there. It's been an absolute pleasure. Thank you for coming on. Thank you, everyone, for watching. People should check out, Jim, your work at Bianco Research, and that also is your handle on Twitter. Joseph, people can find your work at fedguy.com. On Twitter, you are at fedguy12. People should buy the book, which I am holding up proudly for the second day in a row. Joseph, I'll leave you with the final word. Take us wherever you want. What should we take away from this conversation?
I think this has been a great conversation. From what I focus on is the point Jim made earlier, is that we're probably getting to a point where there's going to be more dissent within the FOMC, and so how the Fed proceeds, there's going to be more of a political dimension. So we're going to have to focus on the political aspect. What is the White House saying? What is the senator? What is the Senate? What are senators saying, and so forth? It's going to be much more difficult. Back in the days of Volcker, there's tremendous public support for him doing what he was doing. I don't know if we have the same level of public support. So for me, it's possible that sometime next year, maybe there's not enough political support and we either pause or we even take a step down. So that's what I watch for. Jim, what do you think?
I completely agree. It's easy for Jay to stand there and act. And I agree with you. He did a very good job at the press conference. He acted confident. He acted in control, because we're printing 250,000 jobs a month. You keep hiking rates and we're at negative jobs, it's a whole different ballgame. You think Senator Warren is on your case now? Wait till we get negative jobs and wait till you see how they're going to be on your case then. So yes, and you think you've got some dissents now that you can get rid of with cumulative tightening in the statement and they won't dissent. Wait till we get negative jobs. And your job is going to get infinitely more difficult as we move forward.
There we go. Yeah, Jim, I like your phrase, unhappy doves. We'll have to be paying close attention to those unhappy doves. Gentlemen, thank you so much. Thank you, everyone, for watching. Have a good one. Thank you so much for watching. A few housekeeping items before I let you go. Subscribe to the Blockworks Macro YouTube channel so you don't miss another episode of Forward Guidance. You can find Forward Guidance, the podcast you just listened to, on your favorite podcast app. That's Apple Podcast, Spotify, Overcast, Podbean. That's Podbean as in, on this pod, I've been saying that the Fed pivot is still far away. In addition, please check out today's sponsor. It really helps the show. Link is in the description. Finally, Blockworks is looking for a video editor. Go to blockworks.co/careers to learn more. Thanks for watching.